Welcome back to Red Cloud's Summer Uranium Conference. I'm David Talbot, Managing Director and Head of Research for Red Cloud Securities, and we finally made it to the final session of the day. I thank you all viewers for sticking with us today. If you have missed parts of our conference, we will have replays available on the Red Cloud Financial Services website. That's redcloudfs.com. Now, during our fireside chat today, I hope to get some buy-side investor perspective of the uranium and nuclear industry, and I invite viewers to ask any questions they might have using the Q&A button on the screen. We'll get to as many as we can. But before we kick things off, I want to make some introductions. From Sachem Cove Partners, we have Michael Alkin. He is the principal of the company and general partner of the Sachem Cove Special Opportunities Fund. He's also CIO of the public equities of Lloyd Harbor Capital Management and is investment manager of the fund. He has nearly 25 years of hedge fund experience and has a contrarian and deep value interest investing approach. He was previously an analyst and has worked at several other partners as well. So anyways, Michael, welcome back this year.
Thanks, David. Good to see you.
From Tribeca Investment Partners, we have Guy Keller. He's portfolio manager of nuclear energy opportunities. Now, Guy has 20 years of global commodity trading experience, including 15 as a director with Macquarie, most recently as head of the Asia-based metals trading desk in Singapore. And he's run trading strategies across base metals, precious metals, and iron ore. He began his career with Hochschild's bullion division and then moved to Credit Suisse First Boston in the London bullion markets as a precious metals trader. So welcome to the show, Guy.
Thanks, David. Thanks for having me.
And we have from L2 Capital, founding partner Marcelo Lopez. This Brazilian-based asset management company operates a specialist uranium investment fund that's managed by Marcelo. He has over 20 years experience in the financial markets in London, Sydney, and Sao Paulo. He has a mechanical engineering degree and international MBA with a specialization in finance. So welcome to the show as well.
Thanks, David. Pleasure to talk to you again.
So guys, the theme to our conference last year, was that this time uranium investing is different. And this year, I think it's more of the same. If I go back to some of the takeaways from last year, essentially ESG investors were taking notice. Uranium was finally getting recognition as a green energy source. A lack of support was coming from the US for both nuclear and uranium. Sorry, a lot of support was coming from the US, finally, for both nuclear and uranium. Demand for physical uranium had increased considerably, and both investors, including the emergence of Sprott Physical Uranium Trust for the first time that I can recall in about 15 years, covering the sector by the uranium companies, which is unusual. So last year, prices rose $30 to $40 a pound. So summing up, I think 2021 was really about physical uranium investment. And 2022, I think that's still around and a key issue, but we've got this additional layer of geopolitical risk, which I don't think we had prior, namely the unrest in Kazakhstan earlier in the year, and then the invasion of Ukraine by Russia. So I would say that prices are probably more volatile this year. They've gone from 40 to 63, back down, to 47 or so. So I guess maybe let's start here with the actual spot market and maybe even focus on the physical demand. I think the spot market, it's pretty volatile. There's a narrow demand margin, but we're seeing physical buying that we hadn't seen before, and I think traders are trying to front end that buying as well. So and a lot of this is discretionary. It's beyond market fundamentals. So who wants to kick things off? Start talking about what they're seeing in the spot market with respect to physical demand.
Hi, Dave. I think focusing on the spot market is focusing on the wrong market. At times it makes sense because historically 80 to 85% of what transpires in the nuclear fuel market is in long-term contracts. Occasionally, there will be situations where there's a mismatch of supply and demand, and you will see more supply like you saw post-Fukushima when Japan took off their reactors, and it was a backup in the system and there was surplus disposal, and you had a tremendous amount of oversupply in the market, and it needed a place to go, and that was spot. And because of a very great environment back then and excess pounds, you saw the advent of the investment banks coming in 2012, 2013 and introducing the carry trade, which worked as a wonderful clearing mechanism for excess supply in the spot market. And the utilities played it beautifully by not re-engaging in long-term contracts. They stayed out of the market, and they wound up going in and contracting for 1 and 2 years because Goldman, Deutsche, they could do it because rates were very low and there was an abundance of supply in the spot market. Traders are not in the long-term contract conversation because they can't guarantee supply, but they could derive an additional stream of revenue from the carry trade. They did it well, utilities did it well. That's long in the tooth. A couple of reasons. One is mobile pounds in the spot market are much less than they were. It's difficult to go find a ton of pounds. Price has gone from 17 at the bottom to 47, 48. It's been as high as 60. It bounces around, but it's moving. It keeps moving higher. But the reality is it's very hard for a carry trade to be executed right now because A, rates are going up, and B, the availability and Sprott sitting there picking off pounds doesn't make it easier for them. So now you're testing. You have to remember that going back since 2012, the long-term contracting as a percentage of annual consumption is under 40%. We, as an analog, we saw the same thing from the mid-90s to early 05 when a contracting cycle. Back then, a third of consumption was recontracted in a given year. And then in 05, it went to 150% and stayed at those levels for the next 8 years or so. What we're seeing now is you've had well south of 40% for 10 years, and the spot market is quite thin. And now you have a long-term contract market that prior to Kazakh unrest, prior to Russia invading Ukraine, was becoming less relevant as utilities were finally starting to test the productive capacity. That's the economic productive capacity. So, you know, the market likes to look at what it's presented with every day. The long-term contract is not one of them. But the other thing they do look at is the spot market. But to understand the spot market is to understand how it's formed. Every single day, there could be a price that's posted and there was not a trade, right? Those who are really familiar with the nuclear fuel cycle will know that sometimes mid-month, oftentimes end of month, there are offtake agreements. Traders will walk those pounds down on the bid and the ask side. It's just the nature of the beast. But we are in a period now, there is no analog post February 24th. We're in uncharted territory. So for those who want to stare at the spot price, those who think that the spot price is an indication of the health of the market, the supply of the market, they're looking at the wrong market. Because what we have seen post February 24th, we see contract prices in the low to mid 50s. We see terms within contracts becoming more flexible, becoming more of a seller's market, and that those long-term prices are up from the low 40s, and they're not budging, right? So the spot market is something that we think is becoming more and more and totally irrelevant because you're not going to be able to support long-term production in contracts and energy security, which is really the big thing right now. Sorry to be so long-winded on that.
If I may just add something, David, and I think what happened to the spot market is that Sput entered the market and gave it more, clarity, so people could see what was happening in the market more clearly. But the bull market in uranium will happen once utilities start signing contract. Once a new contract cycle starts, then we're going to see really where uranium prices are. And I think we are in the beginning of this contract signing now. You see Chemical signed lots of contracts, over 70 million pounds, they announced. Encore is signing contracts as well. CGN announced last week that it signed a contract as well with a floor of above $60 for the fixed part. and even Global Atomic as well announced their intention. So we are starting to see utilities look for the pounds. Obviously, they have bigger problems now. They have to procure enrichment and conversion, which is way more important for them, because how good is it to have uranium and not have conversion on enrichment? So they are focusing on what's urgent now, but uranium contract is on the way.
Mm-hmm.
And you are seeing it, prices are moving higher, and the interest is being driven by market fundamentals. That's what's driving it. That's what's bringing fuel buyers out and to the negotiating table. They have no choice. Now, as Marcelo said, they swim upstream. Enrichment's capacity is 40% driven by the Russians, right, versus uranium in the teens. So they need to go make sure that as they transition and self-sanction away, they can get that. And then conversion is next, where the Russians own 30%. So it's a very complicated dance that they're doing, but the market interest is driving them towards contracting. And you're seeing it happen.
Yeah. So would you say that the term price is becoming a little bit more in focus, if you will? It's becoming a more accurate gauge as to what the market is or should be, as opposed to the spot market. Because you mentioned there was volatility mid-month or end of month when the traders get involved, and I'm not saying that there's any hanky-panky going on, but when Sprott gets involved,
why wouldn't you say that?
Well, okay, there maybe, but my point is Sprott's a lot more active in the spot market than any other physical trader has been or buyer has been in the past. Mm-hmm. And what we tend to see when Sprott enters the market, they bought 40 million pounds since inception not too long ago, is prices tend to rise. And that's just a fundamental of, they're buying a lot of product in the spot market, right? And so when they stop buying, it actually settles back. Is this sort of going to be the new normal? We're going to have to worry about volatility because of who's buying?
Well, that's if the fuel buyers were focusing on spot market as their guide. They're focusing on security of supply and production economics now. They were getting there, and actually slower than we thought they should have prior to January. They were getting there. The prices were moving higher. We're very pleased with that, but we were thinking, you guys don't see the freight train that's coming. You're going to see it, and that's fine. But the catalyst was, and who knows the catalyst? You don't know that geopolitical risk is going to drive it. But that's what happens when you've overstayed your welcome at the trough of excess supply. And bulls and bears make money, pigs get slaughtered, right? And when you've overstayed your welcome, shit happens. And so now what we're experiencing is spot price can move around, but that's not changing where long-term contracts are being done, because they're going in, let's wipe out the 115 million-ish pounds of low-cost nonsense pounds, first-tier pounds, that if they don't want profit, maybe it's 120 million, 115. Now add in the next start profit-seeking pounds, right? On demand, that we'll talk about where demand is. Demand isn't 200. Demand is materially higher than that. And secondary supply is in the 20, 25 million pound ballpark and shrinking rapidly. You have a massive gap that needs to be filled, and that's only going to come from much higher prices. And that's why spot will have less of an impact on contract pricing, in our view.
Yeah, and just an addendum here, Mike, if I will. Most of the underfeeding and secondary supply comes from Russia as well, which it's being sanctioned. So you're going to see that disappear as well.
Okay. Do you guys?
Hey, Guy, you're being so patient. Sorry.
Yeah, feel free to jump in anytime. So, does anybody on the panel have a view on what we see as real demand in the spot market rather than financial demand?
Dave, I'm going to jump in here because, again, I'm saying spot market doesn't matter, right? So we can sit here for the next hour and talk about spot. That's not where the market is. The market is RFPs are coming out from utilities. They are starting to sit there and start to do contracting with bilateral discussions, which is how it will really get done. So the spot market, again, if you're in 2015, 16, and 17, if the enrichers are underfeeding, if they're dumping it into the market and there's a lot out there, prices go from your post-Fukushima 65 down to 17. We're now at almost $50. Spot market is yesterday. That's excess supply. That's gone. So what you really want to do is, in our view, that's how we care. We suggest anyone who's staring at the spot market either do one of two things: sell your stock if you don't like the day-to-day movements, or go short the sector, because we'll take the other side of that bet. The market has moved to long-term contracting. If the market doesn't appreciate that, that's fine. Time will tell. It will sort itself out. But to spend all of the time having people focused on the spot market is an exercise in futility, in our view.
Yeah, we're going back to my early days in following the sector, 2007. 8% of the market was spot, but I bet you 100% of the investor focus was on that spot market.
It's because it's the only thing they show. Does the average investor know that the spot market price on any given day could be a trade, or could be really a bullshit bid and ask because somebody wants to move the price down? Do they know that? Probably not. But yet they'll sell and buy their stocks on that, right? So really what they should understand, for all the time people spend trying to figure out where spot price is going, here's a suggestion. Take the time, model out how much conversion capacity exists in the world, how much SWU capacity exists in the world, how much of that is east versus west, and then how much of that is going to need to be overfed because there's not enough capacity. And that's the math we should be doing. I mean, people might not be interested, and I get that. I totally get it. Doesn't mean I'm right at all. I could be dead wrong, but that's the path we're going down. We just don't think spot's relevant. It's not where the market is headed.
Right. Ultimately, I've been saying for years that we need to get back to contracting, and yet we keep focusing on spot, and spot's the other thing that we see every day. So you mentioned east versus west, or do you believe we will get a bifurcated uranium market here? Maybe one with a price for Russian, Kazakh, Uzbek material, and then a premium for the rest of the world's production. You think we're heading in that direction?
I think you have to just, I mean, yes, you look at oil markets right now. You've got Russian oil sold into China and India at a big discount. And other materials coming out of Russia is already paving that way. And that's, without those products necessarily being officially sanctioned. And that's what we're hearing from the uranium sector. The nuclear sector is short term. They've got a problem that longer term they have to solve in trying to make the investment to build or restart Western capacity. But you're already hearing utilities saying that they are trying to look elsewhere. They will honor their existing contracts naturally because they have to, but potentially look elsewhere for future capacity. So yeah, I mean the energy market's already showing us that this is happening. So I see no reason why the nuclear market's not going to go the same way.
Dave, you know how it works with enrichment, right? It's a double-edged sword. So at times when you have excess capacity, all enrichment is force and material, right? It's force in the work in the form of a separative work unit, and you can't shut the cascades down once they're started. So once you have too much, you can wind up using more force and less material. And you could fill orders, use up capacity, which is what your goal, that underfeeding. Now you're in a situation where, Russia has 40% of the global enrichment market, right? A lot of that is done for themselves, but over 20% is done for the outside world. And so that's, as Guy was saying, that's being self-sanctioned away. The Western world wants to get away from it as fast as they can. The challenge that's in that market is because prices were down in enrichment for many years, just like uranium, they did not replace retiring capacity. So as this capacity is short, now luckily in enrichment, the ability to extract the same amount of end orders that are needed out of less capacity can occur by using more natural uranium in UF6. It's called overfeeding, right? And so you can overfeed the reactors to the tune of maybe 10 million separative work units. In plain math, you're looking at 25 million pounds per year. You know how many people's math that is in? Nada.
Right.
And by the way, you want to know the real delta that occurs? The delta that occurs then is what is in people's math is underfeeding from Russia that would come into the market. See ya. Western enricher underfeeding, right? 6-7 million pounds. gone, right? So those deltas right there could swing upwards of 30 to 40 million pounds. Those are big numbers that are yet. The other thing you'll see in models when you look at them that have not adapted to where we are in the fuel cycle and what's going on is you'll see inventory drawdowns that some forecasters use as nothing more than a plug number. And in a period where enrichers will be short uranium and have to go buy it to be able to overfeed, and you see others with the changing world nuclear order, your drawdowns are not going, they're very unlikely to occur because inventory levels are at very normal levels anyway. So drawdowns, the industry has a way of using plug numbers to get to where they want to look balanced. But the reality is you're looking at tens of millions of pounds of deficits for many years.
Just complementing the answer here, Orano, Converdyne have also said that they have the ability to increase production, but they need a response from the market now because they need to sign long-term contracts. They say they're not going to produce into the spot market because, as Michael pointed out, it's not a market that gives them reliability to increase production. So they need the prices to stay where they are because now there's incentive. A couple of years ago, enrichment was below $50. Today is above 130. So now they have the incentive to go out and build more capacity, but they need to sign long-term contracts. Converdyne, Orano, they all said that. So it goes back to the long-term contract in the whole cycle.
Okay. So
and Dave, for those who are trying to learn the industry, right, the fuel side, without understanding each component and the capacity within each component of the fuel cycle, makes it very hard. And it's complicated, but right, it's yellow cake, which is uranium. It gets converted to UF6, it gets enriched, it gets fabricated. Each stage is really important because fuel buyers are contracting along each stage. And enrichment and conversion, those are services. You can't have a service without the product as uranium. But because the capacity was so heavily skewed in conversion and enrichment towards the east, you see the panic will go. SWU is up 100% in a month, right? So they swim upstream, fuel buyers. They will go to enrichment, then conversion, and then where there's a little bit more. And also remember, if you're a fuel buyer, you have a lot of carnival barking junior miners running around saying, we can produce at 50, we can produce it. They're full of shit. They can't do that. They can't. They need much higher prices, but they're in the business of going out and raising money. But so the real reality is, in those who could, they're tiny. You're talking, by our math, 35 plus million pound structural deficits for as far as the eye can see. And that's not picked up in short-term spot trading back and forth with traders whipping it around, trying to get better pricing for a 500,000 pound offtake. We're talking energy security that has been ignored for the better part of 20 years. You asked about a bifurcated market. Up until 2003, there were two prices, the CIS price and the Western price, right? CIS being Soviet state price. That we believe you will go back and see that. And that's where the math gets really funky. Because if you look where uranium is consumed versus where it's produced, the mismatch is staggering. 70% of demand comes from the West. Less than 40% of the supply comes from the West. So you need to start to get those back. And as Marcelo said, you need to incentivize these enrichers and converters and the miners with contracts. They're not going to do it on a spot basis. They won't make the investment. Right.
So you essentially agree that Rosatom is going to continue to underfeed here. They're not going to shut down their centrifuges. Those pounds are going to China.
Dave, forget underfeeding with Rosatom. It's not going to make its way to the West. So it doesn't matter, right? They could underfeed, but here's the real rub. Everyone thinks Russia's has a plethora of uranium. They're going to have to go out into the market and look for it and have to underfeed just because to feed their own reactors and to feed their export reactors. But Russia underfeeding is not a story. It's nobody's story. That's just not, it's not part of it. Right.
Just to go back to Guy's point, he mentioned the oil markets in Russia and the bifurcation. it's actually quite funny because everyone is making money. The US is exporting gas to Europe now. Russia is selling oil to India at a huge discount, and India is reselling the oil to Europe. So Europe is paying the bill, but uranium does not work like that. Uranium, you know where it comes from, and I don't think utilities that there are, especially the ESG compliant ones, are not going to touch that material. And just a couple of years ago, we were all discussing the Russian suspension agreement, and the agreement has to be flexed a little bit in the years around 2025, 26, because there was not enough supply in the West. So I think the run we're going to see in uranium is going to be epic.
Okay. No, thank you for that, guys. So question came in here. How have you guys been managing your own uranium stock portfolios during this latest global market meltdown? And what sort of advice can you give investors who are essentially shocked by the sell-off? So,
well, we don't give advice. You know, we're not in the advice business. I'm happy to share our view on the market. Caveat it, we could be wrong, right? We'd like to think we've been fairly right the last few years, but we certainly do not give advice. But you know, it depends, right? Where it's there is no analog in the uranium market for where we are today. There simply isn't, right? We are in uncharted territories where the risk to the price is on the upside. That's it. The risk to the downside is of course, we're looking every day for it and trying to understand where we're wrong. Could a reactor melt down? You'd like to think not, but stuff happens, right? But we don't think that's part of the story, but there's no analog. So when you look at where oil is post February 24th, and then now where the equities, the oil equities are getting pounded, like the question said, it's a market meltdown, and this isn't immune from it. And so, you know, the other thing I learned over the evolution of the fund is the outside noise was staggering. It is staggering. The sentiment changes on a dime. Guy and I joke once in a while sometimes, or Marcelo, we sit there and say, you chat with each other occasionally and say, wow, sentiment changed. You don't even, and people are going down rabbit holes. And right, it's simple, it's complicated to learn, but once you do, the math is relatively simple. It's subtraction, division, multiplication, and so on. But as we watch it, I personally have learned, I keep a little cash around because, you know, John 672417 in his mom's basement might have said something and he has 6 followers, and now that causes the whole world to change upside down, right? And so we've learned personally just to keep some extra cash around for those days. And you know, we had a reasonable amount of cash, not a ton of cash. So, you know, we go up and down like the markets. Sometimes we like to think we're better than the markets. We try, but we're just focused on the fundamentals. The drawdown for us, the drawdowns from the markets that are moving. If you're, again, it doesn't mean we're right, but if we're right, we just take this as an opportunity to increase what we're doing, because our conviction level, I know they're not on the call right now, but our friends, Art and Adam over at Segra Capital, I don't think they would be upset in me saying their conviction level today is the highest it's been since they started the uranium trade. We feel the same way. I speak for Graham and Marcelo. The fundamentals don't have an analog in a market that already had really nice asymmetry. And I get it, it's frustrating. The market moves up or down, but you know, we can't worry about that. We just got to focus on the fundamentals for it.
Yeah, everything on the internet is always right. So
yeah, David, listen, we have 2 years of markets going straight up. And so I look at it as price is asymmetry, right? So the higher the price, the less asymmetry you have. And on the other hand, the lower the price, the greater the asymmetry, and obviously the return. So people should focus on the fundamentals and stop trying to guess what's going to happen with the market today or tomorrow. The market in the short run will go where it wants to go. But I think it will go much higher in the long run. honestly, the risk relationship in the uranium market is one of the best I've ever seen. The fundamentals are very strong. They are stronger now than they were like 4 years ago when we started trading uranium. And I think it's just a matter of time.
Marcelo and Dave, I just want to go back to one question about Russian underfeeding, because that's not a thing now that's going to enter the West. The tracking codes in uranium, I can't emphasize enough how this isn't like another commodity. This is serious shit, right? This stuff every kilogram is known where it is. Russian underfeeding is not being washed into, once those self-sanctioning and the sanctions and everything, that's not going to be a thing. It just doesn't appear. So that gets tracked. So will the Russians underfeed? Well, they'll do it to get their own uranium for their own reactors and their own export markets. But the random loose stuff that was floating around, if worried about coming in, that stuff is tracked like there is no tomorrow. If it's a kilogram made, they know where the kilogram went. You can't mess around with that stuff. This isn't oil or other gas, or it's not other stuff.
Okay.
Sorry, just quickly as well. I'll just say from my perspective, my nuclear fund is part of, as you know, part of our global natural resources business. So, I wear a few hats and we're across sort of everything. When I look at uranium versus the rest of the resource sector, as Mike said earlier, this is part of a more global macro sort of sell down that's affecting everything. But when I look then at the commodity batting order, which includes uranium, and look at how my level of comfort, the uranium thesis can, with the volatility down is the same as the volatility up. I'm more comfortable that the uranium thesis can bounce back much more quickly than some of the other commodities we look at, where we're in the process of some proper short-term demand destruction and macro negative sentiment. When the dust settles here, this can and it does bounce back extraordinarily quickly. So, whilst we are obviously investors wearing some pain here the last sort of 6 weeks, I'm with Mike. If you there's some stocks obviously that we've made a decision that they're probably less likely to. We like them less, so let's not own them to try to manage the downside a little bit more. But as I said, out of all the commodities I look at, and all the opportunity into the next sort of 6 to 12 months, uranium's a standout by a country mile on every metric. So it's just need to be patient right here and wait for this the noise to quieten.
Mm-hmm. Okay, so the noise, you're talking about, this Russian invasion of Ukraine has had a pretty large impact on the sector. Perhaps we should have all taken that Section 232 review a little more seriously a couple of years ago, when the U.S. government was warned that, there's a national security risk here. So much of the deliveries were in the hands of the Russians and its allies. But, right now, certainly it hasn't done much more than raise uranium prices. But do you think the worst is yet to come? You said uranium's tracked. But do you believe we'll see some disruptions here? I know Cameco's having difficulty getting JV material out from Kazakhstan. Yellowcake is taking deliveries without issue at this point.
Yeah, I just want.
Yeah. Sorry.
No, Marcelo, I'm sorry. I don't want to hog the time.
No, but even Cameco has difficulties receiving hydrogen to actually convert the uranium. So. The problem is everywhere with shipping and transferring uranium from one site to the other. As Mike pointed out, most of the uranium is produced where it's not consumed, and it needs to be transported to the final buyers. I think we're going to see disruption, nothing serious, not to the point of shutting down nuclear reactors, but I think once price adjusts and people sign long-term contracts and give converters, enrichers, and uranium mining companies the ability to forecast for the future and go back to increase production or to start a mine, I think we are going to see this market stabilize. But we're talking years from now, David. Of course, it's going to be fluctuations on the way. and we are prepared for that.
And I would go back to Guy's point and echo what he was talking about. We see this again. It's inelastic demand pretty much. We don't see uranium isn't recession driven. It's not a contraction across commodities. It's not copper. This stuff is needed. It's there. It's base load. It's planned years in advance. And you saw it in 2020, and you're going to see. We think you see it again. So to the question of how do you treat it? Like I said, we keep some cash around because stuff happens, and it gets caught up and swept up, or somebody has a thesis they're running with. But there is risk in the fuel cycle, and that risk means higher prices. Risk meaning transportation risk. Risk meaning who wants to insure a ship? Not many. But there's that all that risk leads to higher prices, because what it's doing is creating a heightened sense of awareness for energy security.
The Russians are insuring, Mike.
Yeah, exactly. We'll do it. Yeah. This is, by the way, it's funny. We talk about uranium, and uranium has kind of got intrigue around it, nuclear power and the Russians, and we've been talking internally, like this is the honeypot trifecta that's happened, right? A honeypot is where someone goes out and tries to seduce a target and compromise them. Well, what's happened? Here we are over the last the communism falls, the wall falls, and all of a sudden we were talking about a bifurcated market now in one of the most serious energy sources in the world, and really dangerous stuff if you don't transport and do it all properly. It became the West became seduced, and all of a sudden it went from 1980, the U.S. producing 40 of its 50 million pounds to now producing none and bringing it all in, and all of a sudden the power shifted from west to east. 40% enrichment, 30% conversion, 40% uranium mining when you add all the east up, and you look at all. So it was seduced into thinking that they're our friends. And we saw that in 2016, 17, we started talking to fuel buyers. We have something out on the internet from 2017 talking about geopolitical risk in Russia. Fuel buyers would snap their suspender and look at us and they're like, we're idiots. And so that was the first one, seduced into that. The second act of seduction in this market has been the carry trade. It seduced fuel buyers into thinking that there's always going to be the supply of uranium out there, because there were low interest rates, and there was some surplus in the market. And then the third that seduces them is the bevy of junior miners that run around saying that they could produce uranium at X price. They have nothing yet. So, and when you actually do the math and add that all up, that they're rounding errors to where the supply demand deficit is. So it's just a very interesting time in the fuel cycle.
Yeah, it's actually interesting because just taking advantage of Mike's last point, TradeStack estimates that we need 80% of the projects that are currently being offered by the junior miners to come online to satisfy supply and demand. But experience tells us that less than 1% of these projects actually become a mine. So we're going to have problems in this uranium market towards in the second half of this decade, for sure.
Dave, I was talking to one of the industry forecasters recently, and we were talking about what's the concept of a deficit, right? Does it mean reactors run out of fuel? No, it means there's less available mobile. And our view is always that price solves that. At some point in time, you could keep going up there, and somewhere there's some stuff that will come out, whether it's down blended for something, but that costs a ton of money, and it's going to require really, really high prices. But maybe some could get jogged loose. So is uranium going to 1,000? No, we don't think so. We don't think it's going to 500 or 300. But can it move a lot higher? Yes. And the concept though was, well, if it's not running out of fuel, then how is there a shortage? To which I would say, there's here in the United States, gas was $2.50 a gallon 6 months ago, whatever it was, and now it's $5. Cars are still running, right? There's just a difference. There's on the margin, there's a different amount, except here, there truly is, on a supply demand standpoint, you're looking at massive structural deficits where they got to really reach deep. And one other thing I will point out, and I don't know if I've said this in our conversations before to you, Dave, is when you look and I talk about analog, I'm sorry if I sound like a broken record. If you look at the last cycle, the narrative is not supported by the mathematical facts. And the narrative was, Cigar Lake went down and therefore prices went higher. Well, the first flood was very minor in 06. And then in October of 06, it realized it wasn't going to open in 07. But the price of uranium had gone from $7 in December 2000 to $41 before the first little flood, which was just temporary, a few months worth. By the time the second flood came, it was in the $60 range. Now, if I'm a fuel buyer and I'm sitting in a seat and I have to decide I need a long-term contract, oh my goodness, there's been a flood. Let me look at it. The quarter before, if I was looking at the industry forecaster supply demand model, and I looked out over a 6-year period, a typical contract period, what does surplus versus or deficits in the market look like? You went from 7 million pound surpluses up to 285 million pound surpluses. Yet the contracting went from 33% of consumption up to 150. There was 240 million pounds. So utilities went on a massive, massive buying spree when there was, by any accounts, a surplus in the market. Also at that time, what you don't see discussed, but if it's not properly put in context, does a disservice to a study of the prior market is, we often hear about what were inventories then versus now. And we often see a chart that says utility inventories, where now they're a little bit higher. Well, commercial inventories are utility inventories plus broker, trader, financial. When you do that, now you're starting to get right there. But what never gets put in those charts is the most guaranteed source of supply that we'll use the year 05 when contracting started, was the pounds that were assured to come in under the HEU agreement, the megatons to megawatts program, where from 05 to 2013, there was 185 million pounds at 20 some odd million pounds a year that US fuel buyers knew was coming into that market under that program. They weren't sure if it would continue past 2013, but that's outside the realm of their contracting horizon. When you do that, you were looking at almost 300 million pounds between utility inventory, between producer inventory and the megatons on a cumulative basis. It wasn't even close. So not only were they staring down the barrel of surpluses, but they had that guaranteed supply, and they contracted like there was no tomorrow. Fast forward to today, that does not exist. There's no guaranteed supply. The secondary sources of supply are imploding. Shut Russia out of the market on the secondary side. The inventory drawdowns won't be there, and you're going to have to overfeed reactors. So it's really a very interesting time, and that's why when I started out, I was busting chops a little bit about the spot market, because that's not where the action is. That's not where the market is anymore. It's just moving past it. It's just psychologically, you don't see if you're not living in the fuel cycle like the three of us here and like Segra does. You're constantly talking to the fuel cycle. That's where you will see the long-term pricing is really starting to move, but more importantly, the terms are changing, and the phone calls are coming in, not out to the producers, and so you're starting to see that change. Sorry to be so long.
I think as well, if we're looking back at history, we had $100 price of uranium with a big pipeline of projects coming to market back then. We had Cameco expanding, we had Paladin with 2 mines, we had the Kazakhs expanding, and you had a triple-digit uranium price there at a time where there was not really a huge amount of reactor builds going on either. You fast forward now, and to all the things Mike said, you add to that and say, we've got one of the biggest reactor build programs we've seen in decades. We've got a primary mine supply deficit, regardless of whether those 50-odd reactors get completed or not. And we don't have any mega projects in the wings, well, one potentially. Cameco, all that low-hanging fruit has been picked. Anybody that says that they're anywhere, that they're going to be able to achieve nameplate on their 2 assets is in dreamland. The Kazakhs are struggling. The only expansion pounds coming out of the Kazakhs in their 2 well fields, the Russians are taking 100% of that for the first 3 years. And then after that, the Chinese are taking 51% Kazakh joint venture. It's the first time the Chinese have been contracting in over a decade. And the restart projects that we've seen from care and maintenance, they raised some money to come into production, but again, so the question there is, even with all of that, there's still a primary mine supply deficit. You've got 50 odd reactors coming to the market the next 5 years, and you've potentially got one mega project in Canada that we'll be lucky to be producing by the end of this decade. Where's everything else? And that's the point again. We had triple digits when there was a heap of things coming online, and now here we are at sort of $47 with even tighter fundamentals and more future demand, and there's nothing in the wind.
So, what do you think the incentive price is? Do you think it's 65? Do you think it's maybe 70 with inflation?
I mean, I think the incentive price is irrelevant. It has to be higher, what that price is. I don't, it's certainly it's higher than 65. If that was a consensus 2 to 3 years ago, because mining costs in every commodity have gone up. The real concern is jurisdiction, is permitting, is environmental studies, is bureaucracy, is lawsuits, is all of those things that are going to be hindering new supply coming through. Where somebody says, "Oh, I've got all the right permits, and I can be coming to market in 3 years." Rubbish, because there's going to be a whole bunch of other things. The price has got to 70, I'm turning on. No. It's not as easy as that, and it's not easy in any commodity to start a new mine in the brave new world of ESG. Add on the stigma associated with uranium, it's even harder. So again, saying we've reached a price all this supply is going to come on, I shake my head and say no. There's a lot of hoops that need to be jumped.
That's a great point, Guy. Dave, last cycle, you needed the 60s, somewhere like that, 50s, 60s. And you went to 137, and again, you had surpluses. And don't take our word for it, right? Go back and read old models. One of the industry forecasters, go subscribe to them and lay out the math and I'm not saying, go and lay out and say, okay, what do the cumulative next 6 years look like in 05? From 06, what do the cumulative next 6 years look like? You went up to a 285, 75 million pound surplus, right? So they're buying from prices going from, they started in 2007. By the time Cigar Lake flooded, it was 60. And then they took it to 137, and the incentive price was half of that. So that's what happens when you under contract, right? What the thing this, in looking at this commodity, for some reason, I don't know why it is, what gets lost on people is the concept of destocking and restocking. When you're draining inventories down, you not only need to go and replace what you have, but then to your consumption levels, but now you got to restock the cupboards, and that's going to get tough. One of the things I should point out, and I'll give credit to my friends Art and Adam over at Segra on this, because it's not in our models. We know it's out there, but they've done some really great work on the SMR space, and they've spent a lot of time on it. And when people think about SMRs, they think, oh, well, they're much smaller. Let's say 100 megawatt SMR versus a 1 gigawatt, so it's 10x smaller. What gets lost in that is it's high asset, enriched, low enriched uranium. So it's 20% uranium, 19.95 versus, let's say, 4.5% now. And also it has a 20-year life cycle, as Art and Adam point out in their recent letter. They do a great job laying it out. And so what you see there is, it's a stunning amount of upfront fuel demand. And when you look at it, I'll just take Maria Korsak from the NEI, the Nuclear Energy Institute in the US. She just spoke and publicly said, we went out and polled our members, which are chief nuclear officers, the guys who make the decisions at the big utilities in the US. And they believe in 25 years, you'll have 90 gigawatts of SMRs. That's double the existing capacity today. That's a long time from now. But these first SMRs are going to be 27, 28, 29. That fuel cycle is tomorrow in uranium years. So that starts in 24 and 25. You could be talking tens of millions, 5, 10, 15, 20 million pounds of uranium. That's in nobody's, it's not in our models. We know it's there, but to Guy talking about this, where's incentive price? I don't know. The market's going to have to figure it out, because the nuclear world order has changed, just like it's changed in other commodities. But what Guy also said was this is people are reluctant to say it, but from 18 months ago, 24 months ago to today, there is a nuclear renaissance that's occurring. Whether people want to hear that or not, that's the math. So.
Okay. Well, with that, guys, we're already about 6 minutes over on our time. So with that said, I appreciate you joining us today on our fireside chat.
Thank you very much, Dave. I really appreciate it.
Thanks, David.
Thanks,
And,
David. Next time schedule like 3 hours so we can cover it all.
We've got the questions. I can assure you, we certainly didn't get to them all, and I apologize to the viewers if we didn't get to your questions. They certainly were a lot of topics we weren't able to broach. But special thanks to this group again, and thanks to everybody for joining. Look for the replays; they will be available on the Red Cloud Financial Services website. So that's redcloudfs.com. As soon as our media team can get them ready. So thank you, everyone.
Thank you, Dave. See you guys. Talk to you soon.
Thanks.
Bye-bye.
So, yeah.
Guys, thank you.
Cheers.